Good day. You are welcome to my channel. This is Kevin Davis Accounting. So today I would like us to begin a new topic, which is depreciation. Now, when I talk about depreciation, this is a loss in value of a non-current asset. You know very well that every time you buy a non-current asset, as you continue using this non-current asset over time, this non-current asset begins to lose value. Okay, if it is a motor vehicle, you buy it in the first year at 20 millions. Okay, then after like 3 years, you can't sell it at 20 millions. You could sell it around 14 millions or 15 millions, depending on how it has depreciated. So we have what they call depreciation. But before we cover depreciation, let me look at what they call a capital expenditure and a revenue expenditure. Now, capital expenditure, this is the cost incurred in the acquisition of a non-current asset. Meaning, if we are going to acquire a non-current asset, the amount of money that we incur in the acquisition of a non-current asset is what we refer to as capital expenditure. Therefore, when it comes to capital expenditure, this is looking at us acquiring a non-current asset, maybe from the place we are buying it from, the transportation costs we are transporting it to the place where it's going to be working from, and also things like installation costs. Now, all those things that amount what we call capital expenditure. So, capital expenditure, these are costs incurred to acquire a non-current asset. Now, when it comes to revenue expenditure, these are costs incurred in the maintenance of the non-current asset. So, this one is all about maintenance. Okay, that means after us we have acquired the asset, okay, then we shall have things like maintaining the asset, things like repairs to the asset, all those things that amount to what we call revenue expenditure. So revenue expenditure is about maintenance of the asset, whereas capital expenditure is about the acquisition of the asset. Now, we have, when it comes to the non-current assets, the non-current assets, you know, they're divided into two. We have the tangible non-current assets, and then we have the intangible non-current assets. Now, the intangible, of course, I'm talking about things like trademarks, things like patents, okay, things like copyrights. All these things are intangible. But then we have the tangible ones. The tangible, we have things like motor vehicle, fixtures and fittings, things that can depreciate over time. So that's what we call the tangible. Now, when the tangible assets lose value, we shall call it depreciation, whereas the intangible undergo what we call amortization. These ones amortize, whereas the tangible ones will undergo what we call depreciation. So I am going to look at the depreciation of the tangible non-current assets. That's the topic I'm going to take you. So join me on this journey as I simplify depreciation for you. So when it comes to depreciation, we have what they call causes of depreciation. Okay, so we have what they call causes of depreciation. What brings about depreciation? What brings about loss in value of a non-current asset? Okay, one of that we have what they call wear and tear. Okay, wear and tear. Now, wear and tear, this is where the asset or the non-current asset begins to lose value as you continue to use it. That means as you continue to use this non-current asset, the value of this non-current asset starts to go down. Okay, so this is the loss in value of a non-current asset as usage goes on. So its usage leads to its fall down in value. So maybe if you buy a motor vehicle, as you continue using this motor vehicle, its value starts to go down. So that's what they call wear and tear. Then also we have what they call obsolescence. Now, obsolescence, this is just like when I say that there is an emergency of a new technology. Let me say we have an asset X in the business. Then they introduce a higher version of that asset X, meaning that the older version is going to lose value due to the emergency of a new version or an updated version. Now, very many of you know very well that back in the day, we used to have what they call typewriters. These typewriters were in all businesses, okay? You find them having typewriters. But then as computers begin to come up, okay, computers come up and then you realize that the typewriters begin to lose value. Now, the emergence of computers led to the fall in value of the typewriters. That's what I mean by obsolescence. Then three, we have what they call inadequacy. Now, inadequacy, this is where, let me say, the asset that we have, the non-current asset, cannot match the demand of the organization. Take, for instance, like the asset that we have can produce 1,000 units per day, okay? And because it produces 1,000 units, then we have an increase in the customers department. Maybe the customers are now more, okay? So that means there will be a demand of us having 3,000 units per day. Now, if the asset that you have can only produce 1,000, okay, and then the demand is actually 3,000 now, that means this asset cannot meet the demand of 3,000 units. Therefore, you'll be required either to sell off this asset and then purchase the one that can produce 3,000. That means this asset now is inadequate to perform at the level that you need. That's what they call inadequacy. So the asset loses value because it cannot match up the demand of the business. That's what they call inadequacy. Then four, we have what they call superfluity. Now, superfluity is the opposite of inadequacy. Okay, so superfluity, this is where actually now the machine that we have can actually produce higher units than the actual units that are demanded. Take for instance that the machine can produce 5,000 units, but based on the business, we only need 2,000 units, meaning that if you continue using this asset whereby you're supposed to produce 2,000, but then the capacity of the machine is 5,000, meaning you're going to incur costs. You'd have incurred while producing 5,000 units, then you're going to incur the same costs to produce 2,000 units, meaning you're not utilizing this asset to the capacity. And because of that, you're going to incur costs one who's producing 5,000 units would have incurred. Okay? That means this asset is going to lose value. Therefore, you be forced to sell off this asset and buy the asset that fits the demand of the business. That's what they call superfluity. And then lastly, allow me to talk about physical factors. Now, physical factors, we have things like rain, things like wind, okay? We have things like fire. When these things affect the asset, you realize that asset tends to lose value. For example, if a building is burnt down, that building is going to lose value, okay? And because of that, you need even to repair, to do some repairs, some renovations. So it is losing value. Now, when those things come in, fire, water, wind, and they affect the asset is going to lose value. So that's what we have concerning the causes of depreciation. Allow me show you what they call factors to consider while calculating for depreciation. There are certain factors you need to consider as you calculate for depreciation. So let me say factors to consider while calculating depreciation. So we are seeing factors to consider calculating depreciation now. The very first one is what they call the cost of the asset. the cost of the asset. So this is a factor to consider. You are supposed to know what is the cost of this asset. You're supposed to establish the cost of the asset. So you need to know how much did this asset actually cost us. So one of them is the cost of the asset. Two, the estimated useful life of the asset. You need to know for how long will this asset be in use in our business. Okay, that's the estimated useful life. Usually, the estimated useful life, that's just like the word I've said, estimated. It is always an estimate, okay, because you're not sure how long you're going to use the asset. That's why we always call it an estimate. So it's an estimated useful life. So three, we also have the estimated scrap value. Scrap value, or what you call residual value. So it means we also have an estimated scrap value. Now, the scrap value, this is the amount at which you expect to sell the asset at the end of its useful life. So meaning that after you have used this asset, you always have to dispose it off. Now, when you decide to dispose it off by selling it, the value at which you are expected to sell it is what we call the scrap value or the residual value. So, and then lastly, you got to know the method of depreciation. So, as much as everything is right here, you need also to establish the method of depreciation. Now, I'm going to look at the method of depreciation after this exactly. So, just sit back and enjoy the video. We have close to 5 methods of depreciation, but then there are always 3 methods that are always emphasized for the sake of our paper and for the sake of our academic levels. Now, when it comes to the methods of depreciation, one, we have what they call the straight line method. Now, the straight line method, sometimes it's called on cost. Now, the straight line method, this is a method whereby the depreciation charge is going to be constant every year. Okay, that means if the depreciation charge is 2,000 in the first year, that depreciation charge will be 2,000 every year until the asset is disposed of. Now, it has a method which is cost minus scrap value minus the scrap value, then you divide by the estimated useful life. Now, this is the method that we can use. Now, sometimes they might not give you the percentages that we are used to. You know, there's a percentage they always give you, but sometimes they might not give you the percentage. And then you'll be required to use the method. Now, on the contrary, they could also give you the percentage. Maybe they say cost of the asset is 10,000, okay, and then they say the asset is expected to depreciate at a rate of 10% per annum, okay, and then they tell you to calculate for depreciation, meaning you're going to say 10 out of 100 times the 10,000, giving you 1,000. Now, like I told you, sometimes it's called on cost, meaning you're going to get the percentage here and then you apply it on the cost of the asset. That's what they call straight line method. Meaning if this is year 1, in year 2 it will also be 10 over 100 times 10,000, giving you 1,000 still. Even in year 3, it will be 10 over 100 times 10,000, giving you another 1,000. So until the asset is no more. So this is what you do when they tell you to use straight line method. Like I told you, the depreciation charge is going to be constant in every year because we are simply applying the percentage on cost. And then since the cost is going to be the same, ideally we must get the same output. That's why I put on cost. So this is what they call the straight line method. So the next one, we have what they call the reducing balance method. Now, the reducing balance method, this one believes that the depreciation charge is going to be changing every year. Like I told you, when it comes to straight line method, we are going to have a constant depreciation charge. But then when it comes to the reducing balance, it means that every year you're actually going to have a different charge. For example, if you say the asset cost us 20,000, that's the cost. Then you say depreciate this asset at 10% per annum. Meaning, in the very first year, in year one, it will be 10 times 20,000, okay, giving you 2,000. But then in year two, this is year one. But then in year two, when it comes to year two, it believes that since this asset has already depreciated, okay, then the cost of the asset is not going to be the same. So it will be 10 out of 100 times the 18,000, giving you 1,800. Now, ideally, this one, remember this one is on cost. Now, when it comes to reducing balance method, we always apply the percentage on the net book value. What do I mean by the net book value? I mean, for example, in year one, we calculated this. That means in year one, there was a zero depreciation. Then after year one, there was a depreciation of 2,000. Meaning, when it comes to year two, you're going to get the 20,000, which is the cost, minus the depreciation, which is 2,000, and then we shall get how much this asset is worth now. So that means you are putting the percentage on the net book value. Now, in year three, it means you're going to come and actually get 18,000 minus 1,800, and then you apply the percentage. So that's what they call a reducing balance method. You always have to go down. In fact, if you see, as the years goes on, this balance has to go down. This balance will keep going down as years go on. That's what they call a reducing balance method. So it's all about us applying the percentage on the net book value of the asset. That's why sometimes I call it the net book value method, because we are applying the percentages on the net book value. Then three, we have what they call the sum of years digit method. Now, the sum of years digit method, this is where, just like the way the statement says, sum of years digit method, it means if an asset has a useful life of 5 years, okay, like this, it means that what you're going to do, you're going to get the sum of all these years, like this. Now, the total sum of all these years is actually 15. So, after getting the sum of years, now you're going to do coming back this side. That means in year one, let me assume the cost of the asset is actually 10,000. Now, these years, they're actually going to form what you call the percentage. So in year one, it will depreciate by 5 out of 15 times 10,000. Okay. Then in year two, you shall have 4 out of 15 times 10,000. In year three, you have 3 out of 15 times 10,000. Like that as you continue going down. Now, they could give you a percentage or a depreciation rate here. Even if they give you the rate here, they're just trying to confuse you. Always go by this. Now, you're supposed to form the rate using the years they have given you. So, and you're supposed to come back as you go, come back this side. So that means if the first year, the last year is 5 years, that means in the first year now, you have 5 out of 15. Second year, 4 out of 15. Third year, 3 out of 15. Fourth year, 2 out of 15. And the last year will be 1 out of 15 times the cost of the asset. So that's what they call the sum of years digit method. Now, we could also have other methods that we can use for depreciation, such as the revaluation method, whereby you're going to consider the opening balance of the asset and then the closing balance of the asset. And then when you get the difference, it will give you what they call depreciation. Now, these are the three methods which are so fundamental for the sake of academic purposes. That means you need to know these methods. The others are also there: production method, evaluation method. But then these are the fundamental ones that you should know. All right, now let me talk about the double entry. Now, when it comes to you doing a number on depreciation, There are three things that will be expected to do. One, you're supposed to do what they call the asset account. Okay. Then two, you're supposed to do what they call the provision for depreciation account. And then three, you're supposed to do what they call the disposal account. Now, listen, when it comes to the asset account, okay, the asset account will look like this. I'm using the word asset because I assume it's general. Now, you could have an asset, maybe an asset X that you bought in 2020, let me assume 2020, and you bought at 400,000, and maybe you had to dispose of this asset in 2022. Okay, then also you have an asset Y that you bought in 2021, maybe at 500,000, let me assume, and so it was also disposed of. Okay, it was not disposed of. Let me just give an example of that. When you come to the asset account, you need to show us the year, that is 2020. Okay, now you're going to tell us that this asset was actually purchased. Now remember, when you buy an asset, there are two things that happen. You credit the cash account and then debit the asset account. Now, this time around, we don't need the cash account, but then you have to keep it in mind that there is a cash account somewhere else that has to complete the double entry here. Meaning, if you bought this asset on the 1st of January 2020, that means you bought it using cash. Okay, then you indicate in bracket that it's X and it was worth 400,000. If there was no any other purchase in 2020, you close off this year like this. Okay, then it means this one is going to become our balance carried down. Now, when you come to 2021, your balance carried down in 2021 becomes your balance brought down in 2021. Okay, then after there was a purchase of this, let me say it was on the 30th of June. So we purchased using cash. This is asset Y and it was worth 500,000. You see this? Now, they told us that this asset actually, it was disposed of in 2022, meaning in 2021 it was still there. So that means your total is 900,000 here, like this. So you have a balance carried down of 900. Now, your balance carried down becomes your balance brought down. Now we're in 2022 here. Okay, so you have 900,000. But now they told us that this asset was disposed of in 2022. So you come and say disposal of how much? Now, irrespective of the amount they have given you that this asset was sold at, this asset account is like a cost account. Okay, so I'm supposed to record every item at cost. For example, if this asset was bought at 400, even if it was sold at 300 or 500, if I'm disposing it off, I'm supposed to come and write the 400 here. One, it's like I'm taking this asset off my asset account, because when I take off the 400, that means this 400 will cancel out to this 400. Now, there's a disposal account somewhere we shall prepare, and that disposal account will appear to be the profit or loss account. But now here, when they give you the asset account, please always, what you do, record the cost of the asset. Now, when you record the cost of the asset here, it means you're cancelling out this asset. Therefore, when you close off, you have 900 and 900, and your balance carried down will actually be 500. Now, this 500 is the asset that is remaining, which is the asset that we bought. Okay, so it means that this is how the asset account will look like. I'm going to solve a number in my next video, and I guess it should be understood. So thank you so much for watching. This is Kevin Davis Accounting. In my next video, I'm going to solve a number on depreciation. Share it to your friends, let them also have a benefit. Until we meet again, it's a bye for now.